I want y'all to know how happy I am to be here because a year ago this time I was chained to a desk doing tax returns and talking to the IRS. Do you know how happy I am right now? I do refer to myself as a recovering accountant because my accounting career was very valuable. I appreciated it. But on that note, just very fast, so you get a little peek around the behind the curtain about Karen and I. This is my wife, Karen. In 2018, I had to report to the ER with the most unimaginable pain I've ever experienced. I was misdiagnosed, languished in the hospital, and my small intestine ruptured. And had emergency surgeries, went septic, nearly died multiple times, went into respiratory arrest and all that. At the end of the day, I spent 100 days in the hospital. I had to learn how to walk again. Eating was its own ordeal. But I healed, but I was impaired physically. Went back to work as an accountant, constant pain, all kinds of stuff. And then I consulted with 5 different surgeons to repair and reverse some of what happened to me, because it was extreme. The 5th surgeon we consulted was the chief of the abdominal transplant unit at Duke University. Transplant, because of their level of expertise, that's what it took. And they replumbed and fixed what needed to be done, and they rebuilt my abdominal wall. Just extraordinary. So since I healed from surgery in September 2021, I am physically whole and restored and healthier now than I was before it happened. It's a gift from the Lord, okay? So I share that with you because it occurred to me about a year and a half ago. I pushed back from my desk at work and was like, there's got to be more to life in the remainder of my career than doing taxes. I wanted more, right? Because I've been blessed immeasurably. So taught with Karen, scared her to death at first, and it's been on this journey. I walked away from my accounting profession last June. The next day, I ran into Scott at our local city club. And Scott and I worked together years ago in a previous job. We'd kept in touch, sort of. But the first words out of his mouth, he said, "Hey, buddy, you ready to join the A-team?" Because I was going to build my own practice in my own way using Circle of Wealth, and then I met Scott. So the reason I tell you that story is for many reasons, including the time we spent together today. I am incredibly grateful to be here with you. So, okay. Now, I will say this too. As much as I went through health-wise, I was along for the ride. Karen paid the price. She had to live through it. So, I love you. Okay, you have a Slido. Please put more words on the board. And while you're doing that, just call them out. What are some of the key benefits of infinite banking? Call them out. What are they? Okay. What else?
Good. I love
that. Is good.
Technology.
That is good. Okay, so all of these are true. All of these are true. But think more broadly. And what I'm going to do in this first part very quickly, what does Nelson say? Think about your thinking. So we're going to think differently this morning about a couple of things, okay? So infinite banking, is it a method? Is it a solution? It's not a product, it's a product structure, I guess you could say. But ultimately, what's the main benefit of infinite banking? It brings hope and security into the lives of who? The client, our own families. It's not about the money, it's about what it does when it washes into somebody's life. That's what I want to be about for the rest of my career. I don't care about the money. I don't care. It's going to take care of itself, right? Okay. If you have more thoughts to add, do that. We can get ready for the next one. All right, so let's use our brains. Let's think, okay? And let me say this too with Circle of Wealth. This isn't learning how to use Circle of Wealth. I want you to think and feel and experience. You don't have to take notes. You're not going to walk away with knowledge you can use about Circle of Wealth right now, okay? So everybody just take a breath and sit back and let's just feel and think. So stretch our thinking. So imagine that where you live, there's a pond, and there's one lily pad in the pond. Okay? Picture the pond, lily pad, right? After 30 days, you come outside, and lo and behold, the pond is 100% covered with lily pads. Okay? And that one lily pad, it doubles every day. The number of lily pads doubles every day from starting at day 1. Day 30, totally covered. Now, if you know the answer right off the bat, please don't call it out. Please don't put it up there if you know the answer immediately. I want us to think about this. On what day is the pond half covered with lily pads? Use Slido. If you know the answer, remember we're working with 30 days. So 30 days, 1 through 30. Which day is the pond half covered? Doesn't matter. So we have a pond with one lily pad. Lily pads double every day. After 30 days, that's 100% covered. On what day is the pond half covered? Everybody got the question? Now think about your thinking. Think about your thinking. Fully covered in 30 days, starts with 1, doubles every day. On what day is it half covered? Y'all are smart. It's 29, because why? It doubles and then it's 100%. So it's day 29. The most common answer just in the general public is 15, day 15. You got to think about your thinking, right? All right. You have a penny. A penny doubles every day. How much money do you have in 30 days? $5,368,709. You're right.
I just did the math because I learned that in school.
Okay, so look at this. Just watch how it progresses. Look at day 15. All right, it's doubled for 15 days. A penny. Tell me when it starts to take your breath away.
Around day 25.
Okay? You could have fun with that on the golf course.
Yeah.
Bet you a penny, double it every hole. Okay. All right, what is that? What do those two examples illustrate?
The power of compounding.
What kind of compounding? Uninterrupted compounding. Right? The first person that can put a bill of any denomination in my hand gets his $100 right now.
Hurry.
Here, you can give one my
Any denomination.
Here, hold on. Here you go. There you go. It was
Kevin-
on the outside.
Kevin's not a very good Walmart shopper, is he?
Listen, so Anna got $100 from me, and Kevin gets Dinner's on them tonight.
Yeah. Okay. There are two things I'm looking for. What just got illustrated? What?
It's what you put into something and how much you will receive out of it whenever you get
Sort of.
the compound rate.
Sort of. What? Transfer of wealth. What else? What did it illustrate? Access to capital. He had money in his pocket and he got up here, right? What else did it illustrate? Leverage. Did y'all hear that? Leverage. Okay? He gave me how much? How much did he get? What's his rate of return? Who said 1,000? As the guy at Think Tank said, is that good or good?
Hey, Chris, what would K-Dog's rate of return been if he'd have borrowed $1 from Mark Knight to give you?
Infinite.
That's what you want to be able to do, right?
Okay, so why did I use that? Why did I use that illustration? What do we teach our clients? Access to capital and leverage, right? Is this helpful? It's fun too. Okay, so let's go into mode here. And y'all just sit back. We're just going to, like I said, I want you to think about your thinking and let's just experience some of this together.
A lot of resources up there, yeah.
It's all right. I haven't used most of them. You don't need them. All right. So we've got an individual. Let's just say he's 45 years old. He wants to retire at age 67. He makes 102 grand a year. 3% inflation on his income growth. Let's say he has zero savings and his investment return that he could invest at is 6%. Everybody got it? So at his age of 67, his income potential will be 3.1 million. That's money flowing through his life. His wealth potential is 6 million. That's all of his income invested at 6%. You with me? Right? That's what that shows. Uninterrupted compounding. All right. So who do we work with? People pay, let's be conservative. 20% in taxes out of his income. Debt service. Is that a reasonable number? 20% of his income to debt service? Is that okay? How much is he saving like a good American? He's saving 5% in his 401k, right? All right, here we are. Watch that right there. 20% taxes, 20% debt service, saving 5%, living off the rest. Pretty reasonable scenario, is it? Okay. Is this most Americans? All right. So again, I want you to watch this number. This is before meeting us. After he meets us, let's say that we can shave his tax bill 10%? You think I could find 10% of tax inefficiency somewhere? Debt service. If we could reduce his debt service, y'all know how to have any method for doing that? We could just reduce his debt service from 20 to 10%. Okay? Let's just do that and see what happens. Watch this number right here. Y'all, this is what we can do for people. You take the typical American who, and we'll see this in a minute, who struggles between their present and their future. They're doing what they know is true to do, and we can come in and make them more tax efficient, reduce their debt service, just modestly, not even eliminate, just reduce. And over their work life, we can wash over $1 million of cash into their life. All right, y'all see what's happening here? People, before they meet us, right? They're struggling to save for their future. They know they have to. They're doing the best they can. Maybe they're pulling money out of their lifestyle to do it. Okay? Where did the savings and taxes come from? Did the client pull that out of their pocket? No, we found the inefficiency. What about debt service? Did we show them a more effective way to pay for the things they do in their life? Right? Just those two areas, y'all. Over their work life. What time frame does Nelson say to think in terms of? 70 years. Okay, this is from age 45 to 67. The earlier you start, the easier it is. This is powerful, y'all. How do you think a client would react to this? You scare him to death, the green goes, right? And then you show them what can happen. This isn't cherry-picked, hand-picked. This is the way it is. Okay? There are 4 types of people in the world, financially speaking. Okay? There's the spender. We meet them all the time. Who is the spender? They buy things that the only way they can pay for them is with income they haven't earned yet. Right? They live below the zero line. They borrow, repay, and they live at or below the zero line. True? All right. There's the saver. These are good Dave Ramsey folks, right? They save and pay cash, save and pay cash, save and pay cash. Interestingly, if they have $30 and pay cash for something, how much do they put back in the account? Typically. $30,000. What should they put in? $30,000 at the investment rate they could get at interest, right? But they don't do it. What's the third type? A wealth creator. This is somebody that saves for the things they need today and their future at retirement to maintain their lifestyle, and they have enough to at life expectancy, and they want the check to the funeral home to bounce. Okay? That's a wealth creator, enough for their life. But there's a fourth type, and Steve spoke about this yesterday. It's the legacy provider. This is who we want to be. This is who we want to lead our clients to be. They make a lifestyle decision of how much is enough. How much is enough? And they fix, and who spoke about past a certain amount of income, it really doesn't add that much joy? Steve, again, right? This is all over what you were saying. So they make a choice of where to live their life, and what do they do with the excess? They bless people now, in the future, and when they're gone. A legacy provider. Who do you want to be? Who do you want to work with? Good so far? Everybody happy? You know, it's much more challenging to do this kind of stuff live versus one-on-one in front of a client. Okay, so talking about life insurance, how much coverage does someone have? And why? Okay, so is the car you drive, is it more of what you want? Why do I have Keith's Corvette up here? Is it more like Keith's Corvette, or is it one step above riding the bus? For most of us. The car you have is the one you want, for the most part, or the best you can do, right? It's not, somebody used Pinto, I think, as a car. What about the house you live in? Do you want to live in the nicest neighborhood? Do you have the best house that you wanted, that you could afford and purchase? Or do you live just one step out of the rain? How about your children? Do you just send your kids to school as a babysitting service and they come home and they may or may not be there? Or do you want the best education you can provide for your kids, prepare for college, prepare them for life in the best way you know how? That could be private school. Okay? On the left side are needs, on the right side are wants, and we live our lives in these areas mostly according to our wants. Would you agree with that? Okay, so let's think about that for a minute. Think about your thinking. So you want to drive the best car you can, live in the nicest house you can afford, do the best by your kids for their education. But when it comes to life insurance, we want to figure out the least amount we need. That doesn't make any sense to me. And this is what you say to a client, right? Does that make sense? What's more important, right? I mean, if this guy, 102,000, we saw this guy age 45, if he punches out, how much does his family lose out on if he dies today? $3 million in income, right? All right, same guy. He buys 500,000, maybe bought 100,000, Scott. Okay, but this guy makes 100 grand a year, he's 45, he has 500,000 of insurance, his investment return we'll call 5%, inflation rate's 3%, all right? How long will the proceeds last? Why does he have the life insurance? Why did this guy buy the life insurance he bought? Yeah, in his mind to protect his family, and he thinks he's overinsured probably, right? Well, that may be true, but does she want to do that? And talking seriously for a minute, how many of y'all have delivered a death claim? My story is I wrote the policy for the husband. He was 10 years older than his young wife. She had 2 kids from a previous marriage. She was a part-time bank teller. He was an engineer, okay? And I figured their human life value and showed it to him and offered it to him. He declined. He wanted to write $250,000. I offered him way more than that, and I documented it.
There you go.
2 years later, he died in his sleep next to his wife. And she came in and I delivered that $250,000 check, and no words were exchanged, but she knew and I knew $250 didn't matter. It wasn't enough. Okay? So let me ask you this. If what you own in life insurance, if what you own in anything doesn't solve your problem, does it matter what you paid for it? Okay? Y'all, we're in probably the most noble industry that exists in the marketplace. All right? That's how long will the proceeds last. How much is enough? Guy's 45 years old. He could potentially qualify for around $2 million of insurance. Does that kind of track with what you know? And we're just dealing with about how much here, right? We're not pulling out calculators and need analysis and all that junk. Do you remember what his income potential was? If he gets all they'll give him, it's not going to replace fully his income, is it? If you get all you can get from the company, it'll only do a certain amount of things. So if he gets his 2.1 million, it's better, right? Y'all, we need to demystify that $2 million is a lot of money. It's not. True? Is that true? Is that a true statement? It's not a lot of money. We need to show our clients what they got. And I meant to do this back there. $500,000, how long will the proceeds last? I love asking the client this question. That's what you got. Is that what you want? Then you ask him here. Do you want this? Does this look better? It's educating folks. They talk about the idea of premature death. Do you ever meet anybody that died on time? All right. Let's think about our thinking a little bit more, okay? I'm going to use a golf analogy. I can play golf, but I'm awful, okay? But golf seems to be a good analogy. So would you rather be a golf club salesman, right? You know all about the whatever it is, what the shaft is made of, nanofiber, carbon, whatever, and the big berth of the head this big, hit the ball 100 miles, right? Help you hit the ball 30, 40 yards farther. And you're a club salesman. You can show it in the right light and how pretty it is, and you can make a living being a club salesman, right? But what if the club you sell the guy helps him hit it 50 yards farther, but it's 50 yards farther into the woods because his swing is messed up, right? What about a swing coach? I'm getting introduced to a couple next week where the wife is a swing coach. That's what she does for a living, right? She makes good money because people want to improve their swing. So our industry is full of golf club salesmen, right? This is a great club, right? You know, it'll help you putt straight or drive farther or whatever. But a swing coach, and that's what we are metaphorically as swing coaches, the clubs, as we're talking about, have their place, right? You got to have clubs to play golf. Probably 3 clubs minimum, I'm guessing. A driver, an iron, and a putter. You can't win the game without a putter. Guess what the putter is in our industry? Life insurance. But a swing coach, what we should do if we're really going to serve the people that we interact with is and I'm being metaphorical, we need to take them out to the practice tee and see what their swing looks like and teach them how to improve their swing. Then we're more informed when time comes to go to the club rack. We're making selections with more knowledge and impact on the client, right? Golf club or swing coach. All right, so let's jump into Circle of Wealth. And here's the part where I want you to just sit back and experience, all right? I'm going to do my best to do what we do with the client at a very high level. I'm going to fly through this. And I'll come kind of in and out and make some editorial comments, but this is the client experience. And if you see something I haven't done with y'all, start doing this. We can know all there is to know about Circle of Wealth, infinite banking. We can know it all, right? I get excited about it, how awesome it is, and how bad the banks are and all that. But unless the client can understand that easily, we need a mechanism to communicate well. So I joked with Scott that hopefully I've got this so well ingrained, you do too. You got to know what to say, right, in a given situation. So I told Scott that I ought to know this so well that he could call me at 2 a.m. and wake me up and say, "Chris, what do you do for a living?" And I would say, "I'm in the financial services business with a very unique approach in that I help people find money that they're losing unknowingly and unnecessarily." What do most people say to that, do you think, if they're anywhere interested? How do you do that? It's a great question. Well, we help people answer the 4 most important questions that we all need to know. Do you know the rate of return that you must earn on your savings and investments so that you can live in the future like you live today, adjusted for inflation, and not run out of money? Do you know the answer to that question? No. Would you like to know? Heck yeah. Do you know how much you'd have to save and add to what you've already saved and invested, how much additional you have to save to live in the future like you do today, adjusted for inflation, not run out of money? Do you know how much money that is? Would you like to know? Do you know how long you're going to have to work beyond retirement age to have enough money to do the same thing? Do you know the answer to that? No. Would you like to? And lastly, if you don't do anything different than you're doing today, do you know how much you're going to have to downgrade your lifestyle and not run out of money? Would you like to know? And that's what we do. Well, how do you do that? What does that mean? Well, we help people investigate we begin with the 5 most common areas where people transfer money unknowingly and unnecessarily. It's how they pay for their mortgages. It's how they fund their qualified plans. It's how they pay their taxes, how they fund their children's education, how they finance their major capital purchases. We start there because of those are the most common areas where people are losing the most money. And there are others, but we're going to measure that in every front. How does that sound? Now, that could be your first meeting. You're sitting down with them, and you have that whole conversation. I could say, I'm in the financial services business with a very unique approach. I help people find money they're losing unknowingly and unnecessarily, and then take a sip of my martini and see if they say anything. That's just what you do. I mean, that's kind of your elevator thing. All right, you memorize that and say that. It's different, right? I help people find money. Huh? What? And we just saw that we do that, right? That's what we do. We help people find money. Good, it's in there. There it is. Thank you, Scott, for doing that. Y'all, I guess there are different opinions about scripts. Now, if you sound like you're reading off a script or you sound like you memorized a script, no. What I just said is a script. If you call Don Blanton, I've got his phone number, the founder of Money Tracks, and say, Don, Chris told me to call you and ask you what you do. What do you think he's going to say? He's going to say word for word what I just said. Did it sound like I was reading a script or? Okay. How do Navy SEALs train? Hard. More specific. Anybody know? How do they train? Real life experiences. What else? As a team, consistently. What else? Cold, wet, and dark. Okay, we're getting closer. So Karen and I we're acquaintances with a couple in Greenville. They moved here after he retired from the SEAL teams. He was part of SEAL Team 2. He was the Master Chief of SEAL Team 2. His name's Tom Shea, wrote a book called Unbreakable. It's really impactful. Anyway, Tom says that SEALs, they don't just train till they can do it right. They train so that they can't do it wrong. That's worth writing down. So in our business, we need to train so that whatever the circumstances is, we just don't know the right thing to say. We can't say the wrong thing. And that opening pitch, that's where I'm at. You wake me up at 3, you can have my number, but don't call me at 2 a.m. But that's what I would say. What do you do? It just comes out. I can't do it wrong. Okay? All right, so I'm talking with a client. Can I role play with y'all? I'm not asking you to talk back, but can I just use your names and talk to you? Okay. So, Sean and Brittany, thanks for meeting with me. Thank you for filling out the questionnaire if you did that online. You know, if you didn't, we'll fill it in. But I just want to give you an orientation, kind of a visual picture of what we're going to use to communicate with each other. So when you look at this picture, and this is open to everybody, when you look at this picture, anything come to mind? What does it look like to you? Plumbing. Okay, that's good answer. That's fine. Pipes and tanks and flow, right? Like water flows. Well, similar to water, money flows through your life in different ways. So you have income that comes into your life. You may save some into your qualified plans before tax. True? Money comes down into your lifetime capital potential. Now this is a big tank because as we saw, that's a lot of income, right? In the case, $3.3 million for the guy that makes 100. But money doesn't accumulate here. Why? Because we experience our financial life typically monthly. Would you agree? So money comes down into the pipe, and the first thing it hits is this brass fitting. It's called the tax filter. That's the first attachment to your money is the government. You pay taxes, right? And if you don't save or invest anything, the next thing you run into is this thing called the lifestyle regulator. Now look at the green. You see what the green's doing? So Sean and Brittany, probably the most important thing I have to say to you, if you hear nothing else that I say, this is the most important thing that you need to walk away. All of us struggle between our current lifestyle desires and our future lifestyle requirements. We all have that dynamic tension. So what kind of appetite does lifestyle have? It's insatiable. Parkinson's law, is that right? The more you have, what? The more you want, the more you have, the more you spend.
A luxury once enjoyed soon becomes a necessity.
Unless we learn how to master the balance between our current lifestyle desires and our future lifetime or lifestyle requirements, achieving that balance can be difficult. But we call that position A. It's actually the definition of wealth. If you have balance between your current lifestyle desires and your future lifetime requirements, you have succeeded financially, is my premise. Very important. Got it? Okay. So if you don't save or invest, the money flows through your life and is gone forever. Now out of your lifestyle, you finance the things that you have debts on. You can have your mortgage, you can have credit cards, you can have auto, whatever your debts are. And then you have your house. Why do I have the house there?
Because it encouraged different.
Yeah. So people likes to sleep inside. Okay. Is there expense for sleeping inside whether you have a mortgage or not? Yeah. So what we have is a housing issue, not a mortgage issue. You always have housing, right? So it belongs on the model. Now, we all realize that when this goes away, I can't get it to trigger. One day your income will go away and all you'll have is these 2 tanks to live off of. True? So we have to make a decision how much we're going to save into these tanks to prepare for our future lifestyle requirements. It's going to require money to live in the future at a certain lifestyle. But this is our metaphor that we're going to learn about and communicate with each other on. Fair enough? And y'all, you can do this live. You can do this very easily live. What do you think inflation's going to do? 3% okay? Fine. Tax rate, we landed on 18%. You can go into a little more detail. Or let the client tell you. It needs to be their numbers. Here's the client. With John, he's 45, retired at 67. He thinks he's going to live to 95. Wife, same age. They have a son named Junior. Clearly, this is not y'all anymore. Okay. Tell me about your income. Well, you make $100,000. Okay. Spouse makes $100,000 as well. Future Social Security. Make an estimate of future what your Social Security is going to look like. There's your income. All right, number 3. Got a 401k. He's got $40,000 in it. Annual contribution's $8,000. The company matches $3,000. What ought to trigger in your mind? There's an opportunity right there. Okay. All right. Spouse has 401k. Similar scenario. Got a couple of Roths we're contributing to here. Got a Roth here we're contributing to. Got some inherited money in a taxable account. Earning 7%, and we got $15,000 in our checking and savings. Okay, maybe that's for a future capital purchase. Maybe it's just what they'd like to have in their checking account. Don't know. All right, those are the assets. 4, debts. They got a mortgage. You just put in current balance, interest rate, monthly P&I. It'll catch up and calculate and amortize it out for you. Okay? I'm going fast on purpose. What's your house worth? Okay? What kind of insurance do you have? Got some term insurance. Here's a good question. If somebody has term insurance, how old will you be when it expires? Not what's the term, how old will you be when it expires? Now, where does term insurance show up? It shows up as a future income source if you die, right? It's not an asset. Everybody okay? And then that's for us. Okay, so we have $200,000 in income, combined income. They're putting 16 in their qualified plans. Their net gross, if you will, is 184. They pay taxes. 275 is the tax on their inherited money, because it's taxable account, right? So your net spendable income is 166, and it flows through your life, and it pays your mortgage and all that. So the expenses is their mortgage payment and their insurance premiums, right here. Now, we separate out expenses because they're typically fixed within reason. Your lifestyle is going to grow each year. If your income goes up by 3%, do most people increase their income by 3% or more? Right. Lifestyle, yeah. Well, for most people, if you're a good American, your income goes up by 3%, your lifestyle goes up by 5%, right? Okay, and this is important to illustrate. Right there, lifestyle, $117,000 a year. Does that feel about right? Okay, it's between $8,000 and $9,000 a month, just to live. Where you vacation, cars you drive. Feel about right? You got to test that number. Did I do that with y'all? Okay, so it feels about right. What you want, if you're going to use, this is called financial GPS. If you're going to take a trip and use GPS, what's the single most important piece of information you need to know first? Hear both. It's where you're at. Okay? If I want to go to Austin, Texas, but I don't know where I am I going to get there? Okay? Financial GPS and this, and you see it's about that quick. About how much? What do you got? What do you got? Well, you just fill it in. Does this look right to you? Yeah, okay. We've dropped a pin. We've got their agreement. This is where they're at. All right. You got to illustrate this point, right? Inflation is a real thing, true? All right. I'm going to advance his age 1 year. Watch what happens to the lifestyle number. What happened? It went up. Mr. Client, do you understand why? You got to establish inflation's a real thing. All right. So this is his financial scenario. Let's see what happens, okay? Stuff happens. Life occurs. He's accumulating. Mortgage is coming down, which we expect, right? Income's going up. Everybody see all that? What age does he want to retire at? 67. All right, at 66. Oh, did you see what happened? See the term insurance? Boom, gone. Okay. What happens at 67? Income goes away. Let's keep going. Social Security shows up. What do you think happens to the tank over here that's full of money? Okay, Mr. and Ms., do you see this? What's going through your mind right now? So y'all, let me jump out of this. How impactful is that to a client? Did I give them any numbers? What did they see? Is that good? All right. Yes, sir.
Hey, Bill, let me call your attention to something real quick. In the past, what we've used in the financial services space has been like an Excel spreadsheet type document with rows of 100 digits, right? Numbers. Left brain, horrible, it had no impact. You know, the advisor's eyes glazed over, let alone the client. On one page, you can show a client a picture, a graphic of where all their money is, how it's moving, when they're going to run out. And Chris, when you did that future value of their lifestyle, just that advancing that in 1 year, showing it going from 117 to 122 or whatever it was. If you don't do that and show them 1 year, when it gets up to 260,000, whatever, they're not going to believe it.
They don't believe it's real.
They
All
don't
right,
believe it.
here's the proof. So age 81, the year before they run out of money, what's their lifestyle number, future value? 341. It's the same as 117 adjusted for inflation. It's real, right? Find some older folks and talk to them about 20 years ago or 30 years ago, cost of things, or do the research. Nick Murray, the investment guy. Do y'all know who Nick Murray is? I mean, he's a dividend-paying stock fan, and that's how he builds his practice and all that. But he's awesome, very sharp wit. Yeah, he uses a postage stamp from 1940 or something like that, and uses that to illustrate inflation. Inflation's real. You got to get them to see it and understand it.
That one that was housing report, can you explain that real quick, what's going on in that housing one?
That's the value of your house at the rate of inflation.
What is the value of your
Yeah.
house at that point? That's what that 1 point, is it 248?
1.2 million.
Okay, that's all I need.
Okay. All right, everybody good? Now, what have we done? We got the data from them. We said, does this look about right? And then we roll it forward in time and it crashes in flames. What's going through the client's mind right now? You're 20 minutes into your meeting. Do they know they have a problem? Are we saying, I've got something awesome you need to know about? Or, let me put it this way. I heard this from the guys at Consolidated Planning, Scott. I love this. So I think a lot of the times what we're trying to do in our industry, if we're talking about sailboats, all right, and we get in front of a client and say, Mr. Client, we've got the most streamlined hull that'll sail through the water, right? We have stainless steel rails and we've got teakwood decks. And whatever makes sails good, we have those, right? And you need to buy our boat, right? When people really need to know, we've got a boat, but their boat's on fire. That's what we need to communicate. Is this client's boat on fire? Did they think it was before they sat down with me? Am I in a good position as the advisor? But we're not done. Reset. And I'm in my first meeting with these folks, y'all. Look how far down the rabbit hole we are. Okay. Sean and Brittany. I told you guys I was going to answer those 4 questions. Do you know the rate of return? How much you have to save? How long you have to work? Reduce your lifestyle? I want to deliver on my promise. Here's the answer to the 4 questions. So the current rate of return on all of your assets based on the data you gave me is 6.97% rate of return. So how much do you have to earn on your savings and investments? What's the definition again? To live in the future like you do today, adjusted for inflation, so you don't run out of money. Okay, you have to increase your rate of return by 1.76%. That doesn't sound like a lot, but that's a 30% increase in risk. True? Is that a true statement? Do you want to take more risk? You can. If in working together, if I could find a way for you to have the money you need, adjusted for inflation, not run out of money, without taking additional risk, would you like to explore that? What about saving more? Tell you what, I'm going to say that for last. What about working longer? This one takes a minute. Oof. You had your plans laid for 67. You were going to start Social Security. What if you had to work to 73? How do you feel about that? Karen, if I told you we were planning to retire back out at 70, but we had to work to 70 or 67, let's say, and I told you, sorry, honey, we have to work till 73, I'd be sleeping outside. Right? I mean, who wants that? All right, what about spending less? A 27% reduction in your lifestyle to not run out of money. So this number, 164,000 age 67, what is that number? Who can tell me? That number right there at age 67, what does that number represent? It's the lifestyle number we saw earlier at inflation at age 67. Everybody? Yeah. So you'd have to reduce your life. Remember what it was? It was 117 and some change. Y'all remember that? You'd have to reduce your lifestyle so that it feels like $85,000 when you retire. How do you feel about that? Barely sleeping inside. All right, and we're going to reset. Now, how much more would you have to save? You'd have to save $3,000 a month more money. So, if in working together, I could increase your financial efficiency. Remember what I do? I help people find money they're transferring unknowingly and unnecessarily, right? If in working together, we can find the money that's inefficient in your life, bring it back to the table, and deploy it more efficiently, is that something you'd like to explore? So, Mr. Client, how are we doing? You know, I know you're a little disturbed maybe, but how are we doing? On a scale of 1 to 10, how does what I do match with what you might be looking for? If they say 10, let's go, I'm ready to rock. Okay, what if they say, that's an 8? Okay, that's good, I heard what you said. Is there something that I covered that didn't make sense or confused you? Or do you not think I'll be able to find the money? No, like, keeping it from being a 10. I don't think you can find the money. We're as careful as we can be, whatever. It's like, okay, I don't know how much money I'm going to find, but you're going to be rooting for me, right? Okay. So we identified a couple of things, and this role play with the client. We've identified a couple of things I'd like to dig down more into. Would you mind gathering just a little bit more information before our next meeting? And we can start looking at some solutions and finding where those inefficiencies are and explore them and see if we can improve your life. Would that be okay? Most people are like, yeah, great, let's go. All right, great. Set the next appointment. Before we go, you're probably thinking this already, so I want to explain to you how I get compensated. Would that be okay? Would you like to know how I get paid? They're thinking it already, right? So you say, I get paid in 2 ways. The one is when it comes time to go to that metaphorical club rack after we've worked on your swing, assuming the products they meet your needs, they're good quality, they solve the problems we've raised today, would you have any issue working with me to acquire those? What are most people going to say? Sure, right? If we're to this point. So it's important for you to know you'll never pay me directly. So the manufacturers of the products that you may choose to involve in your life, the manufacturer of those products, the finance or insurance companies or whoever, compensate me. You'll never pay me directly. The second way I get paid, which I'm really more interested in, and this may have already happened, as you go through this process, there'll be people that go through your mind once you start seeing what's possible. Names will come to your mind. So when we're done, at the end of our process, when we've implemented what will impact your life, in the future, I'm going to ask you for names of 2 families that you care about that need to know what you're learning. Is that okay with you? I haven't asked you that, but I'm asking you that. Was that okay with y'all? Okay. All right, that's the first appointment. We're going to set an appointment for the next time, and we're done. Now, they're going home thinking what? What are they thinking after getting the 4 questions answered? Yeah, I don't want to meet this guy. I have to meet this guy, right? We have to see where this goes. And then you set the second appointment. No, go.
Are you printing it out and leaving it with them so they can look at it?
You know, I'm really glad you asked that. Let me show you why. What was that, 3 clicks, 4 clicks? Anybody know the Jeopardy theme that can whistle? Okay, here it goes. Your financial GPS, your results, where they are, what's required, rate of return. And listen, they tied into GPS. What rate of return? What's the speed of travel of your money? How much do you need to save on an annual basis? Travel time estimate, years work. How long do you have to work? How much do you need to reduce your lifestyle? And then the data they gave you. Click, click, send. So all you need to set up a contact is an email and a name. So you create the contact. I mean, you just add a contact. There's a link in the Circle Wealth software. It's your secure link just for you. Copy it, put it in an email. I've written a template, thanks to Renee, that kind of explains how to do it. You know, take about how much information you may want to gather, a few facts, take 20, 30 minutes, fill it in, send it back. And I get a notification, I click on it, and it populates the financial GPS for you. And in the first meeting, you're validating and adding data. It's their data. And then you blow it up. I mean, you're not blowing it up. It's where they are. They just don't know it yet until you show them, right? All right. So what have we done so far? We're right here. It's 10 steps. It's not 10 appointments. Okay? And y'all, this is part of SEAL training. The reason this works is that we do it the same way every time with every client. We don't miss anything. We know what to say. We're authoritative. And it works. Now, you're not going to walk out of here and go, oh, yeah, I'm ready. No. God, what was I thinking of earlier? I can't remember. I had it sitting over there. I didn't have it written down. But talking about Nelson, Nelson thinks in terms of long term because of his forestry background, right? 70 years or whatever. How long should you capitalize your IBC policy ideally before you access it? 7 years. How long are you willing to work on your business to be proficient at an elite level compared to all of the financial people in the industry to deliver the best outcome for your client and impact their way that maybe their doctor doesn't do? How much are you willing to invest and how much time are you willing to achieve mastery to do that? Our whole industry is, what's the latest thing? How can I get them to, slam bam, let's go? All right, I don't know about y'all, but I'm a professional. I'm going to train like a professional. I love the example Don Blanton uses. He says, a surgeon, right? What's a surgeon do? He washes up, he backs into the operating room, right? Somebody puts the gloves on. That's us in our first meeting. You said that how much no thinking in the OR? All the thinking, all the questions asked, all the training, all the knowledge comes before you sit down with the client so that you're a master. Imagine a surgeon walking into the operating room and he says, you know, I don't know what the surgery is, but you know, I've done this so many times. I'm just tired of going in from the front. Let's just flip him over and go in through the back, right? No, why? Because they've exacted their process and it works. We ought to be willing to do the best. It depends on what you want in your career, in my opinion. And infinite banking, and we think differently, do we not? In our own industry, it's different. So if we want to operate at an elite level, we need to train ourselves and be patient and work towards mastery. It doesn't mean you're going to starve for 7 years, but it's going to take time for mastery. You can deliver what I just did in pretty short order, but you're going to have to invest some study time. And here's probably the key point. Nobody in this room is alone. Y'all, when Scott asked me to join the leadership team of Wellington, he gave me 2 mandates. Build my own practice, okay, and serve you with my expertise. The reason I'm here, I'm your resource. I'm here for you. And we'll have the conversations about, maybe this is what I was thinking of, you know, splitting case commissions and all that. Would it be worth it to you to share some commissions to achieve mastery faster with my help? I mean, Scott's collaborated with me on cases. Just quit worrying about the money. How can we serve our clients the best way and achieve mastery in our field and in our craft and in our careers? That's what I'm going to do. I'm 61, right? This is the last thing I want to be doing as long as I can do it. And I want to achieve mastery, and I want to take as many people with me as I can, clients and advisors. All right, enough preaching. Sorry. It's hard to get up here and not preach, isn't it, Scott? All right. All right, moving right along. Second appointment. Okay, so we come back to the second appointment. We're going to review the questionnaire if there's additional data. We're going to find inefficient strategies, and we're going to discuss private reserve strategy, that's Circle of Wealth's name for infinite banking, and then we're going to explain how life insurance works. Now, I know infinite banking, we're chomping at the bit. We want infinite banking to be the first words to come out of our mouth. What I submit to you, and the reason Scott has bought into Circle of Wealth so deeply, is it may take an extra step or two, but you have more client knowledge and understanding. You have more desire on the part of the client to execute the solution. You've got massive credibility. You're showing them how to fund it. You're not leaving it up to them. You're showing them how to do it. And okay, if people understand the conversation on life insurance, how much are they going to want? As much as the company will give them. Not because they need it, it's because they want it. And you show them how to fund it. Will you write bigger cases if you follow a process like that? Of course you will. You'll also have a higher close rate, in my opinion. I don't know the stats, but I just think it stands to reason you have a higher hit rate. So I did these notes, and y'all, this is so cool. We took a random exit in the mountains because we were running late because of all kinds of stuff, and Brad and I did a Zoom meeting it was a first look with a client. Do you think she's a little disturbed right now, Brad? Thinking about that meeting? A little bothered? Yeah. But what was cool, because I've invested in my training, I'm part of the Circle of Wealth mentor program this year. It's a very intensive program. I had 2 days last week with the founder and the leadership and other mentors. And just those 2 days, as I was going through the presentation with Brad's client, I was finding the money in my head in real time as she was giving us data. I'm like, that's cool. But let's look at this client. So I'm just going to refer to this. I'm not going to show you for the sake of time. So the client, remember that they had qualified accounts that they were contributing above the match. Do you remember that? That's found money. We can talk later about why, if people are going to do qualified accounts, they shouldn't invest beyond the match. Does that, everybody kind of get that? So that we consider that found money. So I've made a note in the ledger. How much is it? $3,600. I'm sorry. The taxes here, the non-qualified account contributions. They had an inherited taxable account. Do you remember that? That they were putting money into. $3,600. There were qualified plans. They put in money over the match. Now, if they're going to reduce their qualified plan contributions, they're going to pay a little bit more in taxes, true? Because it'll be in their income instead of in their qualified account. That's the negative here. And then the Roth, they're funding a Roth. And I called this a Roth alternative, is what I called it. So I found, how much? $13,000. And that's not all the money on the table. That's just what we're going to illustrate, all right? Okay, so you do that behind the scenes. You talk it through with the client, okay? And I'm shortcutting some things here. All right, so what's next? We need to start laying down some principles for the client. Where are we going to put the money? We found the money. Where are we going to put it? Private reserve strategy. So what's the private reserve strategy? The benefits are an increased saving and lower financial stress. The strategy combine a unique type of savings account with a new approach to your major capital purchases. The key is to save in an account with accessibility through collateralization. Is this an elementary visualization of IBC? You can show them what it looks like. Okay? 2 key concepts. We can go deeper into this. 2 key concepts for the private reserve strategy or IBC to understand. You finance everything you buy. Is that in BYOB? Why? You either spend cash and you lose the ability to earn on the cash you spent. It's opportunity cost. Or you lose interest by financing, right? So you finance everything you buy. Number 2, there are 3 types of behavior: the spender, the saver, the wealth creator, legacy provider, right? And you talk about those, you go through those concepts with the client. Okay, so the private reserve strategy in action. And the client doesn't know what we're talking about yet, do they? Well, in this scenario. They don't know what we're talking about. Okay, Mr. Client, so you have a private reserve of accumulated money. It's safe, it's guaranteed, it's compounding. You go to a financial institution using your compounding asset as collateral to get an amortizing loan for like a car purchase, a major capital purchase, and you have structured principal and interest payments back. This is how it works, right? But what's your private reserve account doing? It's continuing to compound because you're using what? OPM. You're using someone else's money and keeping your reserve compounding. You could do that at a credit union, right? That's how it works. So the power of the strategy is you continue to earn compound interest on collateralized funds. So there are different accounts that could serve this purpose, true? It could be a CD at a credit union, right? It could be a savings account. So if we were going to develop our own account, we could name it and it would do it. What are some of the benefits, ideally, we'd like to see in an account? We'd love to have tax-deferred growth, right? That's a good thing. It'd be great if we could also have tax-free distribution, right? What account do you know of that does that? A Roth, maybe? Got to have a competitive return, right? It's just smart to have a competitive return. I don't want limits on my contributions, right? IRAs have limits. Your qualified plan has limits. High for most people, but they have limits. There are limits on where you can put money, but I don't want any limits on where I could choose to put contributions. I'd love those contributions to be deductible if possible. Get a tax break on the money you save. I want to have collateral opportunities because having access to my money is very important, even if I finance something, true? I want it to be safe. I don't want it to lose money. I want to be able to get a loan when I want it, how much I want, on a guaranteed basis. Wouldn't that be great? I want to pay it back, not according to their schedule, but mine. I want liquidity, use, and control of the money. And I want additional benefits, right? Suit protection, right? Protection against disability. If I falter, if I lose my job, if I have a health condition, I want additional benefits that that account would provide to me. So while many accounts work as a private reserve, there are some that work better than others. So pick one. Somebody name one other than life insurance. Don't name. Pick an account. Okay, a CD. The benefits I just issued. Here are the ones that CDs offer. It's got some real estate. So we'll call it real estate equity in the HELOC. Isn't that interesting? What's the most collateralized asset in America? Your house. It gives you two benefits. Tax-deferred growth on the house and collateral opportunities. That's all a HELOC does. Not specifically. Pick another one. That's on the list. CD. What do CDs do? Yeah, we've done that. Okay. Ah. All right, so you get tax-deferred growth, competitive returns, deductible contributions, additional benefits. All right. Anybody ever taken a loan out of a 401k? A risky business, isn't it? You have to obey the what? The rules. You better obey the rules, right? What if you borrow money out of your 401k and then you lose your job? Right? It's fraught with risk. All right. Mr. Klein, are you aware of cash value life insurance? Yeah, I got a State Farm policy or whatever. Okay. It's very interesting to me that of all those benefits in an ideal account that we just looked at, that life insurance has the most benefits in the things we want. Do you find that strange? I find that kind of unique. The only thing you can't get is deductible contributions. All right, so here's how it works. In this example, your policy, your compounding account is the cash value in a properly structured life insurance contract. The financial institution is an insurance company. You have a guaranteed position. You're in the first position to access your cash value on demand when you want it before anybody else the company would loan money to. Loan the money, it's interest only if you wish. And the payments back are non-structured. I can pay interest only for a while. I can pay it off the next day. I could make annual payments, quarterly payments. I could not pay it at all. Not wise, but you could, right? What are your thoughts? I never knew life insurance could do that. Are you really? Okay. So cash value life insurance, when designed and utilized properly, can provide stable growth, cash value, collateralization, guaranteed loan access, no annual tax on growth and death benefits. Additional benefits are available with policy riders. Did you know life insurance could do all these things when it's built properly? Okay, this is the last thing I'll do, by the way. All right, perfect. This is called the 10-minute lesson on life insurance, and I've got 12 minutes left. So, Mr. and Ms. Client, what I'm about to show you, when this is done, if you understand it, you'll know more about how life insurance works than most people in the industry. It's called the 10-minute lesson on life insurance. So for $500,000 of life insurance, there's a minimum amount that you can pay for $500,000 of life insurance. There's also a maximum you can pay for the same death benefit. Okay? Who do you think sets the minimum price for life insurance? The life insurance company. Okay? Who sets the maximum? And y'all don't answer. Would y'all mind answering this question? Who do you think sets the maximum that can be paid for a life insurance contract? The client? Okay. The government. All right, let's think about that for a minute. I find that fascinating that the government cares one bit about what I put into a life insurance contract. The fact that they're interested must mean what? It's good. And it's good in respect to one subject. What is it? Taxes. So what I've just shown you about the maximum amount you can put in a life insurance contract and how it works is baked into the original tax code written in 1913. Okay? So as you go from the minimum cost to the maximum cost, there's an infinite number of product design. Now, again, Sean and Brittany, I'm taking on, y'all are good sports, okay? If you called 5 life insurance agents for the same policy, would they all be identical? They'd be different because there's infinite ways for companies to price and put together life insurance contracts, right? All right, so the maximum, prior to the 80s, this maximum didn't exist. If you had $500,000, you could put it in the policy, $500,000, and have immediate access to it. Okay? So what happened in the late 70s and early 80s? Okay. So qualified plans came on the scene, right? 401ks, moving away from pension plans. Who'd they transfer the risk to, by the way? From the company to the consumer, right? And the government wanted people to put money in qualified plans. So they said, well, this life insurance thing is better than what we want them to do. So to get them to do more of what we want them to do, we've got to limit what they can do with the good stuff. So in the 80s, you had 3 acts that modified the tax code from 1913 with life insurance. TAMRA, DEFRA, and TEFRA, right? They're all acronyms for bills that put limits and governors on life insurance that set a maximum. Qualified plans are these kind. And this line of maximum is important. If you put money in a life insurance contract, Mr. Client, above that maximum line, it's called a MEC, a Modified Endowment Contract. And it means that the gain in your policy is taxed like your qualified plans. So why would I pay $10,000 for a life insurance policy that I could buy for $500? Why would anybody do that? That's called term. It does one thing, gives you a death benefit. But the farther up this infinite product design ladder you go, if I'm going to pay $10,000 for what I could get for $500, I better have additional what? Benefits. So the farther up that ladder you go, the more benefits you get. Make sense? As you decrease, you lose benefits. Term does one thing, right? You're renting your death benefit. If you die during the term, it pays. That's all it does. But as you move up in product design towards this maximum funding level, your benefits increase in life insurance so that we want it funded right up to this level, but not a dollar over, so that it has all the benefits of the tax code, all the benefits of life insurance as it was designed, but not a penny more. What did I just do? We also call that a MEC, but it's a maximum efficient contract. And it's dividend paying whole life insurance properly structured to that maximum level. So you get maximum benefits. And as you continue to fund it, the face amount of the life insurance continues to increase. But all the while, it's maximally efficient as an asset. Do y'all understand this? Seriously. Does it make sense to you? Y'all, how many life insurance agents could repeat this just as a matter of common knowledge in their practice? And from there, how do you feel? Close it out. And you walk through however you want to talk about the next steps. Well, we know about your assets. We know about your income. What we don't know about is what you would qualify for. You remember how much you want? All they'll give me. We have to know what your health status is, right? So let's move ahead and do an application. Just find out what the company will offer to you so that we know what we're dealing with and we can design something that's specific for you. Ready to go? Whatever you want to say. Okay? Now, when I started this, it was about, 11 o'clock? So in 40 minutes, I've done 2 presentations and hopefully closed a deal. The next step would be to go through the application process. Is this compatible with, is this IBC? Is it leading the client like pulling a string, or is it trying to push something towards them? Are you willing to add maybe an appointment or 2 to your process to get complete client buy-in, write a hire case, and show them how to fund it? That's what Scott's bringing to the table with Circle of Wealth, and the whole reason I'm here is to help you do this. Okay? So what I would invite you guys to do, and again, it's not about the money. None of us work for free, right? But if we talk to Brad. Brad, you don't mind me putting you on the spot, do you? Not right now, but y'all talk to Brad because he and I have worked together. Ask him about the experience and if he minded sharing commission for the results he got. I mean, one of the big deals he did almost died because the customer had some concerns. And we were able to answer those concerns. He's like, okay, I'm good. Scott is not in the room. He can speak to this more accurately than I can, but the $1 Million Roundtable has a 5-step suggested commission split. Percentage 20, 40, 60, 80, 100, depending on how much I do and how much you do. How much you do and how much I do. And we just settle that with a handshake before we start working with the client. Do you need to understand the whole system? Sure. But then you may use a component of it because of who you work with or because of the relationship with your client. You don't need to build that credibility or the mystery. You just show them what you think they ought to do and just go to the second part of the meeting and say, okay, here's where you are. Here's what I anticipate you doing that'll improve your position. Show them and say, here's what I think you ought to do, and here it is visually. Just help drive understanding in the client's head. That may be you. You just go in and it's just a tool, not for the whole process, but just to show them what you want to advise them because you already have that trust and credibility, as an example. I'm showing you the entire thing, which for most of us is the way it ought to be used. Y'all, last thing, and it's just personal. My email is chris@wellingtoncapitalreserve.com. My phone number, 864-314-4830. I screen the heck out of my calls, so text me, please. Y'all, I view my role here is to give away my knowledge and help us all reach higher limits. What I'd like to offer is to everybody in the room to take you personally through the Circle of Wealth experience. Personally. No, whatever you write, you write. No compensation, but you need to own your own IBC policy, true? What did we learn at Think Tank? That typically you'll sell annually about 10 times the death benefit you own. Remember hearing that? I'll do a one-on-one with you to take you through the process personally. Do you think your understanding would go up? That's my offer. Thank y'all very much.